Welcome everyone to our first quarter market review. And I am Jeff Elvander. Will take us through what happened in the first quarter, even though the second quarter might, at least the start to the second quarter might be a little more fun to talk about. The first quarter set the table for really what now has been transpiring in the second quarter, which is certainly a lot of market volatility. But back to the first quarter in review, you look at the right uh, right chart, you'll see U.S. equities were down for the quarter, almost 5%. A big contrast to what happened in the international space. Those markets were up on average about 5%. So very different performance across U.S. equities and international equities. That was really in a large part due because of a lot of the tariff talk that was happening in the U.S. and maybe thoughts of isolationism. The U.S. might not perform as well. There would be better opportunities internationally. Of course, at that point in time, a lot of countries hadn't reacted to the tariffs because they had not been set, so they were not placing counter tariffs. So that sent international markets up higher. But it's interesting too when you look at the performance, certainly within the U.S. equity market spot, a lot of the sectors, underperforming sectors, were in the tech space. We've talked a lot about the Mag 7 leading performance. It was interesting to note, you'll see here, we note the Russell 1000 value was actually up 2.1% versus the Russell 1000 growth, which has a lot of tech stocks in there, which was down 10% for the quarter. So some really different return patterns across U.S. equities. Even though the average was down, you'll see there were still some winners in that space. So now is there a rotation happening in large value and large growth? We'll get to that in a little bit. Looking at the fixed income markets very quickly before we move on, fixed income as a whole did a little bit better in terms of their coupon or their yield. Rates slightly declined. That sent them higher. Fixed income really finishing at 2.8, almost 3% for the quarter. Is a pretty good return in the broad fixed income markets, represented mostly by investment grade bonds and treasuries. And then last but not least, unemployment remained really unchanged. It increased slightly to 4.2 from 4.1. The Fed funds held steady, so not a lot of movement from that perspective. We don't note inflation here. The inflation readings, really not any of the readings that we got over the quarter, not that bad. Looking pretty good. If maybe somewhat a little higher, but again, not really getting out of control, but I would say maybe more in control by the Fed in terms of what they've done, which is a positive. So certainly more of the first quarter was around the uncertainty around tariffs, and that's really what sparked a lot of what we're seeing now in the second quarter. Quickly moving through some of the detail, here is a snapshot, the second page here of the U.S. equity markets, and you'll look at that, the top right chart. Again here, orange, large growth outperforming. Teal is large value outperforming. And now if you go all the way to the right, really over the last 1 year period, large growth and large value are basically at the same levels. And so large value has outperformed more recently. And so we'll see, it looks like there might be a rotation going on right now from value to growth. But now over the 1 year, they're in line with, of course, large value winning out over growth stocks over this quarter. And you can see how that looks out with the sectors below, with energy really being the best over the quarter, just consumer discretionary and tech being the worst at well over negative 10% in that low teens. So that's the U.S. equity detail. For looking and diving into the international markets in a little more depth, They outperformed over the quarter, as we noted, some strong performance there. What's been different in the international markets over not only the last quarter or the year, but even more so over the last 3, 5, and even longer than that, you'll see value really being the dominant style over in those markets. And we've talked a lot about the international versus domestic markets, how international markets, that they don't have that Mag 7, they don't have the Amazons, the Netflixes, the Teslas, Metas, Nvidias, and those folks. And so you've seen some different type of performance across those different styles, with value leading the way for quite a while. In fact, over the last 5 years, large value is up over 15%. Again, based a lot on what's happened recently, but that's versus large growth. That's not even at 10% over the last 5 years. So international on the upswing, I think a lot of reason international has been doing better is because of those valuations as well, not as high as in the US. And now some folks are thinking, maybe more about diversification, which diversification does work. And we saw that over this last quarter. Diving into the fixed income markets quickly. Again, let's look at the top right-hand chart. I like this one the most, and this shows the yield curve where it was a year ago to where it is today, or as of 3/31. And that current one is the orange color. 1 year ago, rates were slightly higher, and that yield curve has shifted down as of 3/31. I mentioned fixed income markets outperforming their coupons slightly as a whole, some decent performance, almost 3% for the quarter. That was helped by rates declining slightly at the long end. The Fed controls the short end, which certainly, everyone in the markets, investors in the markets are looking at to see if there's going to be any help from the Fed there in terms of lowering those rates. But I think with this and what this shows from where we were a year ago to where we're at today, back to my comment when we started, the Fed has done a pretty good job with bringing inflation under control, at least in terms of, I think, what investors in the markets feel. And, maybe everyone calls it a soft landing. And it looks like the Fed has potentially gotten us there, certainly around, again, this first quarter backdrop of tariffs and the implications and the volatility that has brought. And over the second quarter, we'll see what those implications are to the Fed achieving a soft landing and what they need to do with rates. And really at where we sit today, I think the market only anticipates a couple of more rate drops by the Fed this year. It's also interesting, if you look at that lower hand chart, look at the last 10 years in the fixed income markets. And when you look at the last 10 years in the fixed income markets, the aggregate bond, which represents really the broad fixed income, US fixed income space, again, mostly investment grade credit, there's corporates in there, there's treasuries, at only 1.5%, yielding only 1.5% over the last 10 years if you're invested in a really diversified, broad US-based portfolio, versus cash, which has been at 1.9, almost 2% for the last 10 years. So interestingly, it hasn't done worked out that well for investors that have been fully invested in investment grade bond portfolio over that time period. All right, that's the detail on those market segments. Quickly, we'll move through the asset class or what we call our kaleidoscope, asset class leadership, and the changes year over year, why diversification is important. Interestingly enough, year-to-date commodities is leading at almost 9%. So commodities, hard assets, when you look back over the last 10 years, the last time they outperformed was in 2022, out of COVID, out of all of that, money being thrown at COVID post-pandemic, and commodities making commodities the best performer in 2022. But that's really the best asset class year to date, and you'll see the worst performing asset class is small growth at negative 11%. So why diversification is important, represented by that balanced yellow box there at 0.25%. So having a diversified strategy, you are still positive for the year. All right, now for the chart of the quarter, thought it was timely. We share this chart every now and again when markets drop, and this one's drawdowns in the stock market. Really, its drawdowns are not uncommon in the stock market, and I really wanted to remind people that drawdowns are frequent if you are an investor in equities. And here we're looking at the S&P 500. And over the first quarter, we certainly reached that 5%. In the second quarter, we were at almost 10%. Second quarter, we achieved that negative 20% that we see about once every 6 years. And the last time we saw a drawdown more than 20%, that was back in January of 2022. So we're about 4 years into it, and we've had another one in the second quarter. Again, over the first quarter, we were in that correction territory for a lot of the different styles and markets. And that's frequent. Over 10%, you'll see here the average frequency is once every 18 months. So not that uncommon in the US equity markets. As I mentioned, this first quarter was a backdrop to what has transpired in the second quarter. We hit bear market territory, or we hit the indicator of bear market, which is a drawdown of over 20% in the second quarter. Now there's been some relief there from the administration, and that tariffs weren't going to be applied really across the board, with right now where we sit today, really having just some of the heaviest tariff right now on China, and a lot, or pulled back a lot. That's helped markets. So not a lot of talk currently about whether we are in a bear or whether we are in a bear market or not. But we did hit that 20% mark and on our way up currently. So very interesting quarters. We start the second quarter, and we will have an update for everyone in our next scoop. So be on the lookout for that, and I'll give a market sort of update at that point. So thanks for joining our first quarter market review, and we'll see everyone next time. Thanks.